Hi, Dad. I'm excited to be back and doing our podcast together again. Welcome to August for everybody tuning back in. We had a nice break over the month of July. Dad, you've been roaming the United States and seeing all sorts of amazing new sights and having just a great time. Been love seeing all the pictures and all the time that you got to spend with family. But selfishly, I'm excited to have you back here in New Hampshire and kickstarting our podcast together again.
Well, thanks. It was a great trip. We haven't had a 7 week trip ever, so it was nice to take 7 weeks and travel the country almost coast to coast, as far as Arizona, then bounce back. But we did see lots of things, and if nothing else, this is one very beautiful country with very varied landscape. It's amazing.
Very varied landscape. When I went out to see you, there was that trip from Phoenix to Flagstaff where I was white knuckling the whole way because of just how mountainous and intense some of those roadways are.
Yeah, you're right. Absolutely. All right. Well, we better get going. We can do my vacation some other time, but it was great. Came back refreshed. Let's talk about real GDP for the second quarter. And real means adjusted for inflation, for those that are unsure what I mean by that. This is a preliminary number, which is always important to take into consideration, but it shows a slowing in GDP growth in the second quarter of the year to 1.5%, down from 2.1% the previous quarter. And on the surface, that sounds like what's going on? So we're going to dive a little deeper to look into what is going on and what drove that number down some, and whether it's good or bad or indifferent. Um, and that always depends on your point of view, right? So the number went down. Why did the number went down? Well, the upward pressure on the number came from three sources, which was consumer spending, uh, business investment, and then exports. But the rate of rise in business investment and in exports slowed from the previous quarter. So exports are still growing, but not at the same pace as they were, which is kind of interesting. The primary export in the second quarter, nobody's surprised by this, is it was oil.
Oh,
Yeah, no, wow, what a shocker that was. Um, Consumer spending is a real hero there. Consumer spending went up very nicely. And what popped into my head here, Kim, is that you and I, in the 2 weeks, 3 weeks, or whatever you decide, we're going to be talking about the inequality of income
Hmm.
and wealth in this country. So I'm going to leave it on the surface right now. Overall, consumer spending went up in goods and services, and it went up by a nice number. Now, in the goods department, one of the large items was prescription drugs. So, yay, old people are buying drugs.
It fits with the demographics.
That's exactly. And Mom and I are doing our share to make sure that we can keep the economy going that way. But also up were motor vehicles, which was primarily light pickup trucks, new light trucks, mostly pickup trucks and some parts. And also we had an increase in household goods. Translate that into mostly furniture. So while people weren't buying a lot of homes, that's in recession, we're taking money and kind of think of fixing up or prettying up where we're living. So that those things help the economy to grow, and had good numbers, certainly good numbers. The reason for the change from 2.1% to 1.5% maybe is a little more interesting. And the government spending fell a little bit, tiny, tiny little bit. And I wish it was more, but a tiny, tiny little bit, which subtracts from GDP. But the bigger thing, I think maybe the bigger story here is that imports rose from the first quarter, and they rose pretty noticeably. Now, so exports went up a little bit, but imports went up even more. So despite tariffs and despite this, tariff 2.0 and all the rest that's going on, and putting increased tariffs on 60 nations and all kinds of fun stuff, although that was July. But in any event, we're living in a tariff world. We brought in more goods into this country, which is why GDP primarily went down, offsetting, consumer goods went up more, but big decline was in imports, which is a negative to GDP. And looking into that, what were we importing? Well, we were importing telecom equipment and semiconductor equipment, which is again part and parcel with the whole AI thing that's going on, and the chip buildup and chip shortages, and also importing industrial machinery. So no big surprises, no big worries there. What kind of got me to go, uh-huh, which was that despite price increases caused by tariffs, we're buying more from overseas. And that gets back to something you and I talked about. We simply cannot make everything here that we need.
Mm.
And it's just not possible. And so this whole concept of, well, we'll bring all manufacturing back to the US, I go, that's an idiot speaking. Uh, that's, this can't happen. You run into them in airports, run into them everywhere, all manufacturing should come back to the US. And I said, and you shouldn't have a car anymore because there'll be no parts. So, makes me real popular at the lounge. But it also means that we are somehow willing to pay the tax as we as importers pay the tax. We're paying a tax, we're selling the goods, we need those goods, so we're able to keep the economy going. Overall, is it an interesting mix? It is. Would GDP have gone down as much as it did without tariffs? The answer is no. But neither are tariffs proving at this point to be horribly inflationary. It's just more like a nagging pain that we need some Advil for. But I look at this number, Kim, and I go, that's not bad at all, given the causes, what's underneath. And at that pace, we're going to see the Fed scratch their head and go, the economy's slowing. They'll take it apart. They'll probably come to the same conclusion and go, but it's not bad. And so they didn't do anything, and they don't need to do anything right now, is the bottom line. And so if somebody heard that not the PCE, the GDP number and thought, oh my gosh, it's slowing down, just chill. It's really okay. And it's going to continue that way for a while. But your business plan should not change. If you're selling to consumers, understand that they are buying. If you are a business that's going B2B, there is some investment going on, but you better have a sharp pencil and a good reason for them to buy from you. There is enough going on to drive the economy forward through the rest of this year, which is the good news. Now, let me end on the bad news because I'm an economist and I can't do otherwise. And that's the personal consumption expenditure for the second quarter rose quite a bit. I'm going to make sure I got the number right. The PCE price index rose to 5.1%, and that's pretty high. The Fed likes that around 2%. And if you take out energy and food, it's at 3.4%, which is still well above where they'd like it to be. Now, at the latest meeting, they did not raise rates. Three of the Fed governors wanted to raise rates, but overall, the majority left rates alone. That's what I'm getting at is if I was a betting man, I'd go with the consensus on this one, which the last number I read was 70% of those surveyed think the Feds will raise interest rates at the next quarterly meeting, which is in September. I think they're right. And I just we'll talk about that if and when it happens, but in case people don't hear from us beforehand, if it goes up 25 basis points, don't panic. The market will do that. Let the market do that, but don't you do it because 125 bips rise in the Fed funds rate is not going to rock your world. It's probably not even going to change your world much. Interest rates may go up a little bit, but it's a progression over time that matters when it comes to this. So you and I will track that, Kim, and we will let people know when it's time to panic. But if they don't hear us talk about the PCE and interest rates before the Fed meeting, because we can't always time it, and it does go up, just take a breath. It's fine. Let the market quiet down afterward. So if they're worried about the GDP, relax. If they're worried about interest rates going up, relax. Just focus on revenue and the profit margin, the things that you and Ryan talk about, the things that you do so well, because really that still has to be the focus. Let the macro kind of make its rumbling noises. It's a storm in the distance. Let focus on today.
That didn't sound like too bad of a bad note to end on for an economist.
Thanks. I'm working on it.
It's still vacation brain, I guess.
That's right. Still enjoying the camping trip. Are you finding people are getting more concerned about the Fed or about GDP and that sort of stuff, or are they focusing on business like I hope they are?
All of my clients, Ryan's clients, so I can speak for them because that's who we're interacting with regularly, are focused on the business. However, our conversations are very much around their margins being squeezed and the pressure that's coming at them from both ends, that it's coming from their customer base and it's coming from their supplier base, right? And so it's just increasing prices or like inability to take on price increases at the customer level. Um, so we're having a lot of conversations with them about just having that pressure coming from both sides and how that's squeezing their margins. And then with quite a few of them, we've been talking about how they're also not able to find the right labor for their most profitable product lines. So we've done like, what is your gross margins by product line or business segment in some cases? Um, and when we find those, it's well, there's demand that exists for those product lines or whatever the service may be for that business segment, but the talent, the labor isn't available to meet the demand. And so that's been a common issue that we've been running into. So it's been really fascinating conversations surrounding the pressure on their margins and then inability to find the right labor to fill the gaps in the spots that have the greatest demand.
Are they able to start either well-paying apprenticeship programs or go to robots or other automation to help augment the production process?
In some cases, we've been looking to technology with a couple of the clients, and there seems to be some good solutions that are there. In a handful of other cases, they're looking into employer branding. I want to say half my clients right now, I'm working on employer branding initiatives where just positioning them in the marketplace as the place to be and work for and really just launching communication strategies of that nature. And that's becoming more and more common to try to attract the right labor. I have one client who she is in the, we'll just say healthcare space. It's really broad, but I'll just keep it there. And she has foregone at this point, I think 16 jobs this year, just because she hasn't had the labor to meet the demand. And she has hired recruiters. She is working with another one of my clients and attending her seminars to learn more about talent recruitment. And she does all the like lots of money, like thousands of dollars each month towards LinkedIn ads and stuff like that, and still just not getting the talent that she needs to meet the demand. So I'd say the labor market combined with pressures on margins is really, I'd say, the most common topics that I'm having with clients right now.
I think, that labor market thing is really fascinating. Let's make that a separate episode because I have some thoughts and some questions for you on that because I
Sure.
think we can dive deeper and maybe provide some help and at least some thoughts to those that aren't following you and Ryan and not getting them there that um, this is an old topic. I remember when the quit rate was soaring and all the rest of that and the changing demographics. How do you attract millennials? So we're it's not the same problems, but it's not a new topic either. So want to do that? Want to make it a separate discussion?
Yeah, I think that sounds great. And what's also fascinating to me is that I have those conversations with my clients, but then at the same time, I also know that it's difficult to get a job right now. I've heard that from just neighborhood folks and other people looking for jobs, and they're having difficulty getting placed at various jobs. And so it's like I'm one of 1,200 resumes that's being submitted. So it's a very interesting two sides of the coin that I see, one from the business perspective and working with clients, and then others just locally and talking with colleagues or people that I run into.
Uh, I can understand that the demand is not uniform,
Mm.
and you don't need more car salespeople, uh, you know, and you really don't need a lot of realtors in a large part of the country. So part of this is going to be what state are you in, what part of the country are you in, and what's happening there. And the other part is if you're a producer of some kind, um, what skill set do you need, and how are you going to get that skill set? And that's the tricky part. Um, I I'm breaking here for a moment. I'm going to assume we're going to continue this discussion, and Bill can separate it into two episodes. Am I right about that? So we can.
And we can, yeah, Bill, if you don't mind separating at this point. Well, we should probably close out. So I'm sorry, Bill, you're gonna have to do some editing. Because we'd probably want to close out the first episode. So maybe we just pause and we just say we'll leave this for another day and we can maybe pick it up for a different episode. Does that work?
Okay. Yeah.
Okay. I don't know how to pick back up though. Hold on. Trying to think back to the thought. I was talking about the two separate sides of the coin. So, Bill, maybe if you go back to where it's talking about the two sides of the coin. Okay. Um, so it's been very interesting to me, just that two sides of the coin. So I think your idea, Dad, is spot on. Let's do a full episode on this because I think there's a lot for us to dive into from the different business perspective, manufacturers, distributors, professional services. I work with all of them, and they all seem to have the same 50,000 foot issue, but it's complex in different ways when you start breaking it down and diving into the details of what's causing the issue. So I think this would be a great conversation for us to go through together.
I think so too. So let's do it.
All right, sounds good. Well, I'm excited to be back and doing these again, as I mentioned at the beginning. Thank you everyone for tuning in. And Dad, I will see you next week when we are talking about, I believe, the yen that we're going over next week.
Well, let's switch it over. Let's talk about the labor thing first to continue this talk, and then we'll talk about the yen.
Okay, I like it. Sounds good. See you then.